winds are blowing the other direction. And so the ground's moving quick, want to figure out what's going on. Um, I think one good way to start, Matt, is looking at the Marcus and Millichap, the 20-year outlook. Um, some folks are getting into real estate for kind of the quick flip, get in and out, get in and out, and we can just be so focused, as we often are here on the Gray Report, of what's the latest, high frequency data, what's going on with what's the unemployment rate today, what are jobless claims, what are the interest rates today, which is important to know when you're in the middle of transactions, you've got deals going, but it's a lot of, also it's a lot of noise.
Yeah.
And it can be hard to see the forest through the trees and to look at, okay, what's the next 5, 10, 15, 20 years going to look like? Because for most investors, again, not all, but for most investors, investments into commercial real estate are long-term endeavors. They're not short-term flips. And that there's nothing wrong with doing something short-term, but most of these are long-term projects and business plans. Not usually 20 years off. I think the average hold period is around like 4.5 or 5 years.
Yeah.
But having that vision is important.
Well, and I think a lot of times it can scare people off if you can't get out
Mm.
quick. If you got everything locked up for 5 years, I don't want to give up that control. But I think sometimes I'd argue that that's good. That's a good thing. You don't want to be jerking around the whole
Yeah.
time and reacting to every single thing.
Yeah, I know a lot of investors who say, "Look, I like the illiquidity because I can't just like panic sell or something. It's in there, it's locked up. I don't have to think
Yeah,
about it other than just, I get my distributions, I get my reports, and if I had that cash sitting there, I'd spend it. Or I'm not sure what I would do if it was in the stock market. I'd just be trading it, and I want something that's much more steady. And it's not that, we're necessarily going to, like, okay, we're going to hold a property for 20 years, because cycling through is a good way to increase your returns. But it's more of where you want to be allocated over for the long period of time, assuming you're going to be kind of cycling in and out of projects. But looking at your overall portfolio, what sectors, what asset classes do you want to be in? And looking at a long-term time horizon, because a lot of people, when they're thinking about whether it's retiring or building up that nest egg, you know, it's, yeah, the next year, 5 years is important, but let's look at 20 years. What that's going to look like. I think a lot of people would say, maybe I'll be slowing down from working in 20 years, or at least have the option to do so. I love what I do, but I want to have some, yeah, I want to be a choice rather than I have to keep working. So that's what I really appreciated about this. Now it's a video. We're going to kind of play the video while we discuss a little bit. But the the conclusion that John Chang from Marcus and Millichap makes. All right, so we're going to be looking at a video from Marcus and Millichap, John Chang, who really leads up a lot of their research and their a lot of their content creation, thought leadership. He's a really smart guy based out of Phoenix, and they talk about a lot of what we just spoke about, Matt, of trying to filter through the noise and not looking at necessarily as for high frequency information, but looking at the prospects over the long term. And what they did was look at the past 20 years to give us maybe an idea of the next 20 years, but then kind of baking in the different demographic trends and opportunities to kind of understand where some of those opportunities might lie, and just what is good to keep in mind. And I'm just going to fast forward the video, and you can find this video. I mean, if you're subscribed to the Gray Report newsletter, you got this video sent to you this morning. But you can find it on grayreport.com. Um, and I just want to fast forward, really just looking at 20 years, really from 2001 to 2021, where we have most of the data. We can look at some of the price trends, seeing basically a decline between '07 and '09. And then looking at some of those rent trends, see that quite a slight decline over that period. It was averaging a little under 900. It peaked in about 2007 over 950, dipped down to basically 950, and then just look at a straight trajectory over the next decade, and then COVID, a huge parabolic leap up. And same with price trends. They obviously are linked to each other. This is the average price per unit. It's not surprisingly kind of linked to that average rent price. And we saw a decline, in the Great Recession, but then we've been just on a meteoric rise ever since then. And so, in his point, is that you could have invested in at the peak. And right now he's looking at what the S&P 500 did, but you could have invested in at the peak back in 2006,
Yeah.
2007, and you would have made incredible returns if only if you had a long-term time horizon. If you had a short-term time horizon, you could be caught up in trying to catch a falling knife and sell at the wrong time. I just want to watch this graph. So this S&P 500 since 2001 has returned 416%. Apartments, though, have returned 458%, not including the tax benefits. Now, retail is just about the same, 461%, which I think is a little bit surprising. Because retail, I think there's a little bit higher
Yeah.
risk there. But retail has done pretty well. Industrial, though, is really kind of the darling. It was really on the same track as multifamily up until about 2016, 2017. But then it just started accelerating. A lot of that is due to, the boom in e-commerce and logistics. And, that's not has not been slowing down by any means. So it really went parabolic during the pandemic. And is the top performer, delivering an 848% return since 2001. Now, Office was the one laggard that, it was kind of tracking the rest of CRE, but then it's really kind of taken a hit um, uh, s- in the pandemic. Now, it hasn't really dropped significantly,
Yeah.
but you basically have a very similar return, or a little bit less return compared to S&P 500, 341% return for office properties compared to a 416% return to the S&P 500. So I think that's a pretty good return, and pretty much all CRE asset classes outperform the stock market besides office. And what this doesn't bake in is all the tax benefits that commercial real estate offers as well. That really can be a driver that's hard to bake into that overall price.
Yeah. I think one of the things that it's like, this is just, yes, it's just a video, but it's also worth watching. And sometimes I get as much from a short video as I do from like a lengthy report. And this one really captured a lot of what I was feeling. I think his refrain was "keep your eyes on the horizon." He said
Yeah.
he'd been saying that since the beginning of the pandemic, and it's true today as it was, in March of 2020.
Yeah.
I think that being said, I think that what keeping your eyes on the horizon allows you to do is actually pay attention to the correct thing, not necessarily only pay attention to 20 years from now, but pay attention to the things that will be impactful in
Mhm.
5, 10, 15, whatever years.
Yeah.
So like, for instance, interest rate increases. I think that might be one of those levers that will really disproportionately impact things down
Mm.
the road.
I mean, they will and they will. I mean, I don't know. Maybe I disagree. I mean, I think that's short term, 100%. I think in the long term, I think that's the noise. I think that's a lot of you have to pay attention to on making transactional decisions. But looking at where growth is and all the other factors that are much more long term, I think overweigh even interest rates. I think you can make short term decisions that put you in a bad spot right now with interest rates. Um, but I think so the next piece that he gets into is really the demographic shifts of millennials. Millennials are entering their peak home buying years, and this I think it's really interesting. He really compares it to when the baby boomers were entering a similar point in their lifespan. So he looks at housing values between 1983 and 2021 as a kind of a similar period in time, and just looking at the inflation adjusted return um, of just single family homes and single family home price trends. Here, let me go. So baby boomers are growing older, so they're age 87. They're going to be needing getting these senior housing facilities. And so he's really saying senior housing and medical office demand is going to continue to increase. And I think those are two good sectors. There was some overbuilding in the senior housing space in anticipation of they call it the silver tsunami, all these baby boomers that are aging out. But again, by 2042 is kind of the date that he's marking as we're going to see a real increase in demand for senior living and medical office facilities. There's also this massive wealth transfer. It's the largest transfer of wealth in, I believe, in history. So 84 trillion with a T, a big capital T. $84 trillion is going to be transferred from the baby boomer generation to older millennial children. So that's a lot of money. Millennials are going to are going to see potentially, and that's we're going to see some interesting effects when that take place. And I think that's already started to occur, just at a much slower pace.
I think that one of the things that we have been saying for so long is that there are these generational trends that are butting up against housing demand, and you hear all this stuff about a housing bubble, and like, is it coming? And it's hard to picture a housing bubble. This kind of again, keep your eyes on the horizon. It's hard to picture a temporary housing bubble doing any kind of impact on the millions of people that are going to be forming households, on the amount of money that's going to be transferred from one generation to another, on these huge, decades-long forces that are pushing up against it. They're really kind of peaking in the next 5 years. And that's what I thought was really one of the most interesting things, is like, we really are maybe at the peak of this moment, like right now.
Yeah. I think it'll be interesting. Because we're seeing record high prices, and maybe we'll see some demand destruction because of that. But I think, to what you were saying, Matt, is that there are some forces so powerful that could overcome that. And it's good to have a watchful eye for. But how many people who have taken a pause in the housing market doesn't mean they're never going to buy a house, or they don't want to buy a house.
Yeah.
It's that, like, okay, maybe not right now is the right time, but if prices do see any kind of softening, there's a long line of folks who are ready to line up. And if we do see a recession, which we're going to get to here just a little bit, about talking about soft landing or not, and if the prices come down, there's a long line of people ready to go, and interest rates in that recession will decrease and will allow for an attractive buying period. But even with the higher interest rates, it's just a shock right now. But the higher cost of capital is all relative to the amount of growth in the rate of growth. And so people were buying houses, back in the 80s, when they had that chart of, prices continuing to rise. Interest rates were 10 to 18%, and people were buying houses and thinking they got a good deal. And it's because the growth was carrying them through. And the big question right now, though, is, are we going to continue to see that continued growth? And it's really for how long. So it'll be an interesting couple of quarters as that kind of shakes out, and see where it all goes.
Yeah, and I would argue that this moment will be extended only because it's so difficult to create new supply as well.
Yeah, that's a really good point. I mean, there's some markets where there's just no. I mean, we were up in Lansing, Michigan, the past couple days, doing due diligence on a pending acquisition we have up there, and was talking to a real estate investor in the market who we were touring one of his properties. He said, there's a couple of corporations, big companies that are moving into Lansing. They made some announcements. They're like, we're going to bring 300 employees in right now. And they looked at the housing market, and there are 150 houses on the market in the area for 300 of their employees. Yeah. And it's not as though those 150 houses are even all they even want to buy any of those 150 houses. So like maybe a third are appropriate in the locations. So maybe there's 50 for the 300. And then there's a whole other market of everyone else who wants to buy a house. These are high paying jobs of people who are like, they just need to find somewhere to live. The result of this is what we're seeing is increased demand for apartments, because everyone who is looking to buy a house all of a sudden is like, I'm going to wait just until I understand the market, and maybe I'm going to rent for another year or two.
And that's what I think is the benefit of apartments. It kind of has a little bit of both ways. If there's high housing demand, there's going to be high apartment demand. But if if things happen and houses, maybe there's a housing crash or some, apartments are still kind of insulated a little bit. And there's always going to be that demand there, whether it's coming up from people that are planning on buying a house, or whether it's people that are staying off and remaining renters because they simply can't afford a home. There seems to be a place for apartments in any of those kind of paradigms.
Yeah. And I think that's why it's important to have kind of a diversified portfolio of not all C class, not all B class, not all A class, because, different kind of income levels are going to perform differently in different parts of the economic cycle. And you're going to have some wages and incomes lag and some that are accelerating, and then some are going to catch up. And different economic time periods, hit different sectors in a different way. And as people kind of move up and down through the economic ladder, the people who are living in C class properties and they move up to the B move up to the A, and then but then the A class apartments maybe get too expensive and a recession hits. So you move down from the A to the B. People sell their homes, they move into the A class or the B plus class. So you get all this moving around. Now, like we've said a million times, Matt, recessions aren't good for everybody because it's economic disruption, and there's evictions, and you get more volatility and higher vacancy just because you just have people moving out more. So it's not good, but it's more in the margins than many other industries, I'd say.
Yeah.